Welcome to Lesson 1, Intro to Forex Trading. We begin this lesson with a quote from Eleanor Roosevelt, who once said, "The future belongs to those who believe in the beauty of their dreams." Believe in the beauty of your dreams, folks, and you will go far. Now, let's start by talking about what actually is the Forex anyway, right? The foreign exchange is a global market in which currencies are traded one against the other for a profit. Now, unlike stocks and other markets, the Forex is decentralized, meaning there is no central exchange. Everything is done online. And the Forex is the most liquid market in the world. By comparison, here's the New York Stock Exchange, which only does $28 billion a day. Here's the equities market, the US equities market, which does $191 billion a day. Or the US futures market, which does $437.4 billion a day. Okay, this is in terms of volume. You can see the Forex absolutely dwarfs the rest, trading at $5.3 trillion a day in volume. Okay, so the Forex truly is the most liquid market in the world. Now, let's talk a little bit about the structure of the Forex market. The Forex is traded bank to bank, meaning there is no centralized exchange as there would be with other asset classes. It's also known as the cash market and spot FX. It's a game between the bulls, who are trying to push price higher, and the bears, who seek to push price lower down. Let's look at the Forex market hours. Now, Forex is traded between 10 p.m. GMT on a Sunday, right the way through to 10 p.m. GMT on a Friday. Okay, so the market is actually open 24 hours a day, 5 days a week, from Sunday to Friday, Sunday night to Friday night. Okay, now there are 3 sessions traded each day. We have our Asian session, which is also commonly referred to as the Tokyo session, and that takes place between 10 p.m. GMT and 11 a.m. GMT. We have our European session, which is also known as the London session, okay, and that takes place between 7 a.m. and 4 p.m. GMT. And then lastly, we have our US session, also known as the New York session, and that takes place between 1 p.m. GMT and 10 p.m. GMT. Okay, so our 3 sessions, Tokyo, London, and New York, also known as Asian, European, and US sessions. Now here are our sessions, and you can see that there are times when we have overlaps occurring between the sessions. In other words, this Tokyo session is still open when London opens, and for a short time there, for a few hours, you have both sessions open, okay? And then you see it happens again between London and New York, where New York opens while London is still itself open. Okay, now those 2 periods throughout each day, Monday to Friday, are, as I said, the overlapping of the sessions. Now, when this happens, we can expect an increase in volatility as more traders make their way into the market to start placing trades during these times. These are the ideal times to place trades because of the increased volatility. Okay, as a trader, you want the volatility, you welcome volatility because it means that the market is moving. Okay, and as a trader, you don't particularly care, in which direction the market is moving. You only care really that the market is moving. Okay, and so that's what makes these the most ideal times to trade. Now, the 2 overlaps that are the ideal times to trade are between 7 a.m. and 11 a.m. GMT. Okay, and that's the overlap between the London opening and the closing of Tokyo. And then, of course, from 1 p.m. to 4 p.m. GMT, you have the overlap of New York. So in other words, New York opens up whilst London is still open, and for a few hours there, you have both sessions trading simultaneously. Okay, these are those ideal trading times. Again, from 7 a.m. to 11 a.m. GMT, and then again from 1 p.m. to 4 p.m. GMT, Those are really our windows, if you like, especially if you are a scalp trader or an intraday trader. You know, these are the ideal sessions for you. Okay, that's not to say you can't trade in the other sessions. You can trade at any time, but these are most ideal. Now, for all of the periods throughout the day, it's not recommended to trade. Although again, as you know, I'll reiterate it again, you can trade. It's just not recommended if you're looking for you know, quicker returns and you're looking for, or if your style is to be a scalper or intraday trader. Okay, now those setups can happen during these times. As a pro trader, you want to focus your attention more on the periods where there is higher volatility and therefore more likely opportunity. Okay, and so the times to avoid placing trades because of the decreased volatility are when the overlaps are not occurring. So for example, for the Tokyo session, between 10 p.m. and 7 a.m., it's just Tokyo. There are no other sessions open at that time. And so because there are no other sessions open at that time, there's, you know, significantly decreased volatility. It's what's known as the dead zone. Okay, and so we want to try to avoid, if we can, try to avoid placing trades in the dead zone. Okay. Then between 11 a.m. and 1 p.m. GMT, okay, this is when, you know, after the Tokyo session has closed, but before the New York session has opened. So essentially during this period, it's just the London session. Now, even during this period, this is still considered to be, you know, one of the higher volatility sessions throughout the day. But because you don't have that overlap, you do go back to a decrease in volatility, just making this period of time less ideal to trade. Okay, and then finally, between 4 p.m. and 10 p.m. during the New York session, okay, and you know, after 4 p.m. that's when London closes, or rather the London session closes, and so, you know, from 4 p.m. right the way through to 10 p.m. when Tokyo opens up again, you know, this is really the dead zone. Okay, this is really considered to be the dead zone, and so new trades are certainly not advised during that time. Okay, and here are those periods. So you can see, you know, there's more time throughout the day where we're either A, less likely to find opportunity, or B, the opportunity we do find is you know, has a lower chance of success because of the decreased volatility. Okay, so there's more time throughout the day where that's the case than there is, you know, ideal trading conditions. Let's talk about the daily trading range. Now, each currency creates a daily trading range, which is calculated by subtracting the low from the high of each day and finding that difference. Okay, now knowing and understanding the daily trading range, or DTR, and average daily trading range, okay, sometimes those terms are used interchangeably, but they are different terms. Okay, so the average daily trading range, or ADTR, for each currency pair you're looking to trade, helps us to A, focus on pairs which are moving or trending, whilst avoiding pairs which are not, okay, so those that are range bound. B, it helps us to identify where the market is likely to lose steam. All right, in other words, if the average daily trading range is 100, for example, we know that after 100 pips of movement in a particular direction, again, doesn't matter what direction, but you know, 100 pips of movement in a particular direction, we know that the market is likely to either retrace at that point once that's happened, or just you know, start to consolidate for the remainder of the day until the next day. Okay. Now, it can also help us to manage realistic expectations around the length of time a trade would likely take to reach the target. So for example, let's say we're looking at a pair that has a daily trading range of 100. And let's say we're looking at a position where we're targeting 150 pips with the position. To figure out how long this would likely take, let's review the formula. So it's going to be the target over the daily trading range. Okay, and so 150 pips over 100 pips All right, so by using this formula and understanding daily trading range, we know that if we are to wait and allow the market to reach our target, so if we're a swing trader, for example, and we're going to wait days and weeks for the market to hit our targets, then we know that at a bare minimum, it's going to take at least 1.5 days for the market to hit that 150 pip target, considering its daily trading range is only 100 pips. So we're only expecting the market to move 100 pips in a given day. Now, 100 is the average, right? So that's not to say that, the market can only move 100 pips a day. Some days the market will only move 20 pips, but other days the market will move 300 pips, 500 pips in a day. Okay, this is just the average. So this just gives us a good sense and helps us to manage our expectations around the trade and how long, exactly how long we can expect at a minimum to be in the position. Now, trading is like an auction between the bulls and the bears. Okay, the Forex market is similar to an auction in which buyers or bulls are trying to push prices higher, and sellers or bears are trying to do the opposite. They're trying to push prices lower. The price at which buyers are buying is known as the bid price. Okay, the bid price. The price at which sellers are selling is the ask price. Okay, so you have the bid price, which is the price buyers are willing to pay, and the ask price, which is what sellers are selling at. Okay, the difference between the two, the difference between the bid and the ask is known as the spread. And this is how brokers largely make money, is on the spread, the difference between the bid price and the ask price. Now, here's a pro tip. The easiest way to remember the different names is to think of it in the following way. When you list an item for sale, you're valuing it at a certain price and asking your potential buyers to pay this price, right? But when you're the buyer, when the shoe's on the other foot and you're the buyer, you've also valued whatever you're buying at a certain price. This is the price you're willing to pay. This is your bid. So just think, when you're buying something, you're bidding on it, right? You're placing your bid. Think, in terms of anyone who's ever purchased a home before. Right? You know that you have to put a bid, and the seller has to accept the bid. So the seller is asking for a certain amount. You, as the buyer, are only willing to pay a certain amount. Okay? And so that's your bid. Now the broker, as I mentioned before, the broker, who is the only one willing and able to facilitate the transaction between yourself and the opposing party. So if you're the seller, then the opposing party would be the buyer. If you're the buyer, obviously the opposing party would be the seller. The broker is the only one willing and able to facilitate that difference. Okay, and they do so because they make money on the spread, which again is the difference between what you're willing to pay and the price at which the seller is willing to sell. The market moves in only two directions. Okay, there are only buyers and sellers in the market. Therefore, the market can only do one of two things. It can only go up or it can go down. You might be thinking, well, Chris, that sounds a little bit counterintuitive to me, because what about times where the market is moving sideways? Okay, so technically you're correct. Technically, there is a third thing the market can do, and that is to consolidate or go sideways, right? But when we have sideways movement, when the market is moving sideways, it's only a temporary reprieve as the market regroups to build momentum and break out in one of the two primary directions, which again is up or down. Okay, and when we have sideways movement, we also can refer to it as consolidation, bracketing, accumulation, and ranging or range-bound markets. So if ever you hear any of these terms, it's just referring to the fact that the market, rather than moving in one of its two primary directions, is instead experiencing a temporary reprieve in which we move sideways, allowing the market to build up, to rebuild that momentum and give us the breakout. Okay, and start moving in one of the two directions again. Let's talk about trading styles. There's swing trading, there's intraday swing trading, and there's scalp trading. Swing trading, okay, I want you to picture a passive investor, someone who's not interested in the day-to-day, someone who has a bit more capital than others and can afford to take on longer-term positions, and someone whose strength is in identifying long-term trend direction and then trading in that direction. Okay, these are swing traders. All right, and swing traders focus mainly on the monthly time frame, the weekly time frame, the daily time frame, and usually the 4-hour time frame. And generally speaking, again, this is generally speaking. This is not to say every swing trader does this, but generally speaking, the 4-hour time frame is the absolute smallest time frame on which a swing trader will likely trade. Okay, and with swing trading, trades can last days, weeks, months, and even years. All right. Again, they're not interested in the day-to-day. They're, more focused on the bigger picture, longer-term direction. Then you have intraday swing trading. Now, intraday swing traders are still swing traders, but where a normal swing trader will look to enter the market and hold a position for days, weeks, months, and even years, an intraday swing trader will still look to trade the larger swings, but may get out of the position in a matter of hours and days rather than a matter of days, weeks, months, and years. Intraday swing traders focus on the daily time frame, the 4-hour time frame, and the 1-hour time frame. And intraday swing traders, like all swing traders, rely on good, solidly trending markets. And lastly, we have scalp trading. Now, scalp traders take the opposite approach. Scalpers actually look to get in today and out today and are very much concerned with the day-to-day goings-on of the markets. And scalpers focus on the daily time frame, the 4-hour time frame, and the 1-hour time frame for general, overall, longer-term, bigger picture direction. But as far as actual executable, tradable analysis and setup, scalp traders are usually using 15 minutes and below, okay? Because a scalper relies more on the short-term volatility in the market. And with scalp trading, trades can last up to a few hours, but never more than a day. You'll never see a scalp trader hold a position longer than an entire day. Now, as it pertains to trading, there are 3 methodologies: technical analysis, fundamental analysis, and what's called the efficient market theory. Okay, technical analysis, according to Investopedia.com, is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. But at Kickstart, we have a little bit of a different definition. We define technical analysis as the study of the market's language. See, the market speaks to us through its candlesticks, its movements, and its patterns. And if we can learn to identify what these are, what they mean, and how to use them, well, then we've unlocked the secret to consistent profitability, which isn't really a secret at all. Okay, it's about learning the language of the markets, becoming fluent so you can understand what the markets are trying to say. Then we have fundamental analysis. Now, fundamental analysis is the study of geopolitical and macroeconomic forces on a country's economy and the reaction the markets take, pushing the currency up or down. There are traders who only focus on this style of trading. They often take advantage of shorter-term, simpler strategies with easy, clearly defined entries, easy, clearly defined exits, and easy, clearly defined reasons for taking the trade in the first place. These traders, though, often disregard technical analysis altogether, often to their peril, preferring instead to only focus on the fundamentals. Okay, at Kickstart, we understand and recognize the importance and indeed the value of studying fundamental analysis, which is why we dedicate an entire section to it in this course. But we strongly believe the technicals are king, and that ultimately, even if fundamental forces generate short-term volatility, the market will return to its known patterns and technical movements. Okay, and so for that reason, you can consider Kickstart traders to be a bit of a hybrid, right? We are hybrid traders in that we marry the technicals and the fundamentals, but we have, we place a preference in the technicals and we place priority in the technicals, believing that the fundamentals, when they do occur, push the market to fulfill the technicals faster, essentially. Okay, so in other words, fundamentals give us a short-term injection of additional volatility and volume, which could push the market to its destination, its ultimate destination, faster. Okay, and then we have efficient markets. Now, the efficient market hypothesis was developed by an American economist called Eugene Francis Fama in 1970. And it's a theory which describes the market's movements as fully reflective of all available information. In other words, it's the belief that markets are efficient and reflect all variables, including both the technical and fundamental factors. So I mentioned at Kickstart, you can consider Kickstart traders to be more hybrids. We are more along the lines of, believing in efficient markets. In other words, a marriage between both the technicals and, as I said earlier, the fundamentals.